When Barb's husband died suddenly at the age of 51, she found herself not only facing extreme sorrow, but also a myriad of financial decisions and unfamiliar tax issues. What's up, guys? I'm Jeff Montgomery, and welcome to another episode of Tax Planning on the Whiteboard. Okay, so in our whiteboard example, we're going to take a married couple, married filing jointly, and we're going to assume a taxable income of $230,000. $230,000, and we'll say that's for tax year last year, 2021. Okay, that squarely puts them into the 24% tax bracket. Now, what we're going to assume is an unfortunate event happens and one of the spouses passes away in 2021, and then the surviving spouse is left with $180,000 in taxable income, okay? Now, that's taxable income. That's after deductions, after either itemizing deductions or taking a standard deduction. We're going to say a taxable income. And what does that do? Now remember that the last year that they can file married filing jointly is in the year of death, which would, in this example, 2021. So now if we are in 2022, we have a surviving spouse that has to file as a single, okay? Assuming nobody got remarried or anything like that. So $180,000, what tax bracket, top tax bracket, does that put a single filer in? Well, that would put that single filer in the 32% tax bracket with 20% less income. So that is important. That is commonly called the widow's penalty. So remember, the widow's penalty is something that can get you. You have to be careful of it. You have to be aware of it. What are some possible solutions with this situation? Well, one thing, a possible solution could be, what about accelerating some income, okay? Maybe there was medical deductions that took place in that year of death. Maybe there were some medical expenses, I should say. And maybe it makes sense that very last year, married filing jointly, you could maybe accelerate some income into that last year, maybe through some asset sales, maybe selling some stocks and bonds in a taxable brokerage account, something like that, where you could accelerate some of that income into that tax year, maybe offsetting some of that income with a medical expense deduction in the year of death for the decedent spouse. So that is a possible solution. Okay, the second thing I want you guys to be aware of is what's called the step up in basis rule, okay? Step up in basis is something that was threatened last year during Congress, but it has remained intact, thank goodness. So we got to step up in basis. So exactly what is a step up in basis rule that was threatened last year, but it has remained intact for 2022? So basically what this means is under current law, the estate of someone who dies with assets held outside of retirement accounts. So we're talking about brokerage accounts, your maybe primary residence, maybe some real estate holdings, outside of retirement accounts, doesn't owe tax on their appreciation. When heirs sell these assets, they only owe tax on the growth after the date of death, or the fair market value after the date of death. So this is an extremely valuable tax planning tool that, like I said, was threatened last year. They talked about getting rid of the step up in basis. We don't really know how that would have worked as far as the mechanics behind the scene, but it is still intact for this year. So let's give you an example. Let's go to the whiteboard so you can understand this. Now, most states are non-community property estates. So what we'll do, non-community property states. So what we will talk about is, let's take a very simple example of a residence, of a primary residence, okay? So it's their primary home, and we're in a non-community property state. And let's just use an example of a couple that bought the home years ago for $200,000. So that was the original purchase of the home, and it doesn't matter when, just you can say 20 or 30 years ago. So the original purchase price was $200,000. Now, let's say over the years that primary residence has increased in value, and it is now $1.1 million. Look, in today's real estate market, that might not be a far stretch for some folks. So now we're going to also say this is jointly, right? This is a jointly held property between two spouses, jointly held between two spouses. Now, what happens when one spouse passes away with this step up in cost basis? Well, in non-community property states, that will be a 50% step up. So the surviving spouse new cost basis will be $650,000 as the cost basis. Now, this is extremely important because as of the current tax code right now, we are exempt of selling a primary residence. If we've lived in the primary residence 2 out of the last 5 years, we're exempt up to $500,000 of gain. And if it's worth $1.1 million and our step up is now $650,000, then we have a $450,000 gain that if the surviving spouse decided to sell this property, we would have no capital gains tax. No capital gains tax in this situation. Now, let's talk about the idea of what if the property is not sold right away. Now, there is a two-year exemption on selling this property as a surviving spouse. If you don't get remarried and you sell this property within 2 years, that $500,000 exemption is intact. Now, if you wait after 2 years to sell this property, so greater than 2 years, and you sell the property, you still receive that $650,000, that step up in basis, but now your capital gain is now lower and cut in half to a $250,000 exemption as a single filer. Again, because you are greater than 2 years on the sale of that property. So if we go back to this example and we're talking about the married filing joint couple and then they file as a single, and we're talking about just the step up in basis rule, remember we had a $650,000 basis, right? The house is worth $1.1 million, and let's just assume that we waited 2 years and the property is still $1.1 million. It has not gained any value in that 2 years, but now that 2-year exemption has passed, so it's after 2 years, okay? After 2 years, and now our exemption is only $250K exemption. Well, remember, what did we have as far as a total capital gain? We had a total capital gain of $450,000. Sold it for $1.1 million. Our cost basis is $650 because we got that step up in cost basis. Guess what? That's going to leave us a $200,000 taxable gain. And it's because we didn't either sell it within the first 2 years or we didn't remarry and have another capital gain and change the asset. So we're talking about a tax difference, guys. If you look at this, we have a 15% capital gains tax rate, right? But also, because of income, we are caught with the NIT tax, N-I-T-T, net investment income tax. So N-I-T-T, and that's like an extra Medicare tax. for a single filer over $200,000, which this would be total income or modified adjusted gross income, that's an additional 3.8%. So all of a sudden, we have an 18.8% tax hit on that $200,000 gain. Guess what? That's a $37,000 additional tax bill compared to if we had filed that tax bill or if we had sold that property earlier than that 2-year limit which expired. So that's why tax planning, I think, is so important. The takeaways from this class right here is just to be aware. Be aware our tax code is full of gotchas. Now on part 2, we're going to talk about what happens in a situation where a spouse passes away and the surviving spouse inherits their IRA. So stay tuned for part 2. Don't forget to hit that subscribe button, and we'll see you next time on Tax Planning on the Whiteboard.